breaking the mould with our investment director, Russ Mould. How are you?
Very well, Nina. How are you? Thank you for coming in again. Lovely to see you.
Not at all. It's good to get January out the way, isn't it?
It is. Oh, it's my dad's birthday month. It's not all bad, I promise you, but it is nice to sort of park that. We'll look forward to Valentine's Day now.
Yeah, not far off, is it? So, big question. What's the fuss?
Okay, the fuss is all going to be about a trading statement from widget distributor Electrocomponents, results from non-life insurer Lancashire, and also a Bank of England inflation report.
Okay, let's start with the widget people then.
Yeah.
Surely they do more than that, Electrocomponents.
I'm being a bit rude about them calling them a widget distributor. They probably get quite upset with me. It's a FTSE 250 company, Oxfordshire based, and it is a massive distributor of electronics and maintenance products, to give it its proper name, i.e. it distributes anything from silicon chips to power tools, industrial cabinets, protective clothing. Now, it distributes products for more than 2,500 companies. It actually is responsible for looking after stocking over 500,000 products and supplies 1 million customers a year with them. Now, it does it over America, the UK, Asia, Europe, and over 60% of the business is actually online. So in terms of what they do and where they do it, it's not a bad proxy for global economic growth, or you can certainly argue as such. So it'll be very interesting to see what comes out of their trading statement for the third quarter on the 11th of February, Wednesday. Now, if you look at the chart behind us here, which shows you the year-on-year sales growth progression we've seen since 2010, it's hit a bit of a flat spot. There are now tentative signs of a rally. So when we look at this trading statement, it'll be all eyes on the year-for-year sales growth. Now, if you go back to the interim statement in November, all honesty, they were not a thing of beauty. Boss Ian Mason was a little bit downbeat. Prices were under pressure. Volumes weren't that strong. He said America was good, but the UK and France were quite weak. And this is all despite good volumes of the Raspberry Pi low-end computer that they're distributing. So it was a bit of a mixed statement, and overall the company's found profits growth quite hard to come by in the last 2 or 3 years. Now, the reason why some AJ Bell Youinvest customers hold it, and it's always a name in the lights, is it's a bit of an income stock. It's a sort of company that income hunters look for. Last year, it paid an 11.75 pence per share dividend, and on the current share price of around 205p, that's a yield of 5.7%. Now, you'll see from the chart behind us, again, the share price hasn't done that well because of the problems they've had with volume growth and pricing pressure, but there are suggestions from some analysts the yield might provide a little bit of support here. Now, for those of you looking to do some more research in the company, you've got to make sure that income is safe, that yield is safe. Earnings per share are forecast by analysts to be around 13 pence for the year that's going to finish in March. Now, that gives dividend cover of 1.1 times, which is a little bit skinny, all things being equal. So when you look at the full year numbers in May, check out the cash flow, make sure that that's still holding up nicely, because overall the balance sheet's pretty good and interest cover's fine, but just do check on that cash flow to make sure those dividend payments are safe.
Okay, I enjoyed that arm move, Russ.
It's good, isn't it?
Yeah,
Twice
nice.
then.
Twice the double. Moving on to Lancashire, not that I'm biased.
No. Moving on to Lancashire, home from home, eh? So there you go. No, it's an interesting one. Shares, again, another very ugly share price. If you look behind it, a little bit more of that hand movement there. Yeah. £9 down to 6 over the last 2 years, though it has just begun to rally a little bit. So all eyes now on their full year results on the 12th. But overall, yeah, it's had a bit of a tough time.
So why have shares been so weak?
Yeah, no. Sorry, I've got you going now, haven't I? No, it's interesting. Lancashire is an insurer and also a reinsurer. So it actually insures the insurance company's business, which is quite an interesting concept. Okay. And it's a specialist in certain key areas: marine, energy, acts of terrorism and natural catastrophe. Right. Now, you might not get this or believe it from reading the newspapers right now, but there have actually been very, very few major incidents in the last few years. Certainly nothing to compare to Hurricane Katrina in the States or the Japanese tsunami, for example. So actually insurance companies haven't had to pay out very much. So they're sat on plenty of cash. There's not that much business. There's only so much business to write. So pricing's been under very, very severe pressure. So Lancashire's now actually saying to its shareholders, we think we're going to give the money back to you, because that's a better use of our capital than putting it at risk at very low prices, insuring contracts where we think we might not make a profit. So Lancashire actually paid out a special dividend in December of $1.20. And if you look at analyst forecasts for the full year next year, then again, the yield works out at around 9% on the current share price. So again, one that income hunters might warm to. But again, the important thing here is do your research. Remember, they're offering you a big yield, but you've also got to think about the risks that are inherent in the underlying business.
Always. Last but not least, the Bank of England.
Bank of England inflation report. That's coming out on the 11th, and we all know what the December number was. It was 0.5%. This is the bank's quarterly update on what it thinks the sort of future is. Now, Bank of England Governor Mark Carney has been constantly saying, You know, look through this oil price weakness, look through the short-term inflation numbers, because they aren't representative of the long-term trend. So when he was on his holidays, Davos, Switzerland, working really, really, really hard, Carney was still talking quite a tough game on interest rates, saying that he thinks they might rise in the UK quicker than the market's currently thinking. That the gilt market, the government bond market, is pricing in the first rate increase now for 2016. So let's see who's going to be right. Mr. Carney, who actually calls the shots and pulls the trigger, or the bond market? I favour the bond market, but we'll see.
We shall see. Not long now.
Not at all.
Russ, thank you
Pleasure,
very
Nina.
much. That was Russ's Fuss for this fortnight. Thank you very much for listening.